At NCS, we solve technology problems where others can't. Challenge us. Search NCS Australia.
The Australian Financial Review.
Hello, I'm James Thomson, Senior Chanticleer columnist at the AFR. Welcome to our weekly news breakdown of all things business, finance and markets. With me today, as always, he's like a snake slithering around in the reporting season swamp. It's Anthony Macdonald. How are you, Anthony?
So happy to be here, James.
Fantastic. Well, this week we look at the new war that's broken out in the banking sector. We ask why 3 CEOs left 3 blue-chip companies in 3 days. And we look at whether we could tame inflation without hiking interest rates. But first, Anthony, the February profit season really got underway this week, and on Thursday we saw something that's highly unusual. 2 companies, both worth at least $1 billion, saw their share price plunge 30% in one day. And on the same day, the ASX hit a record high. What is going on here? Who are these companies and what went wrong?
James, we've said reporting seasons are getting out of control. These ones really proved it. The first was AMP, closed down 27% on Thursday, having traded down as much as 31% during the day. The other was Temple & Webster, somewhere I'm not allowed to buy lights from as we renovate our house, James. Closed down a stonking 32.6%. And I want to throw in a third, not quite as much, but Pro Medicus, an absolute darling of the market last year.
Yeah.
Dropped 24%. All huge falls, James. 27, 33, 24%. Like they're sinking like a stone on the open from the first trade of the day and then failing to turn investors' heads through the day. I mean, the funny thing about these drops is none of them was existential. No company died. There was no big bust-ups, no big scandals, no one sacked, no huge write-downs, no one going broke. It's all just about margin and really pretty small earnings margin misses that have really just blown up in their faces. Yeah. So if you look at AMP came out and said it's not making as much money on its investment platform as people expected.
Yep.
Now, the downgrades from analysts, everyone thinks it's going to make probably 10% less profit this year, 10% less profit next year, 10% less profit the year after. All right? So it's a chip to earnings, but yeah, sure, the company's not going broke. Yet the shares tank 30%. So it just shows, James, there's no room for error. And to be fair, we're seeing share prices react very strongly on the upside as well. I mean, Commonwealth Bank and ANZ, which they were the notable ones this week. I'm sure we'll get to them a bit later. But the volatility is just so savage on the downside. So brace yourself, James. We're in for a wild fortnight ahead. You know, the past 2 reporting seasons have brought about record share price moves. This one, it feels like this one's going to smash those. I don't think that's a controversial statement at all. I'm not beating it up. It's just what's happening in front of our faces.
Yeah. I mean, share price moves a couple of years ago, I think we used to think, 8%'s a big move, 10%'s a big move. But now we're seeing companies have a third of their market value wiped off in a day. It's rather remarkable. Anthony, does it speak to the impatience of investors, do you think? Obviously, the market's at a record high, as I said, so that says there's a lot of expectation built into stocks. It feels to me like fund managers, who were never the most patient people to begin with, they just can't afford to have anything to do with a company that makes a couple of missteps. You know, maybe you get one thing wrong, you're going to get hammered, but there's a little bit of forgiveness. If it looks like you're going to make 2 or 3 bad announcements, it's just sell and move on, isn't it?
Yeah, there's a lot more hot and fast money in equity markets trading around these results as well, James. I mean, there's materially fewer large active investors willing to step in front of the fast-moving trains.
Yeah.
And then we've got the rise of ETFs and passive investing as well that's changing the way that shares trade throughout the rest of the year. Come reporting season, it all can just really blow up.
Yeah, I can't remember anything quite like 30% falls, though. It's something else.
All right, the big news of the day, James, is the leadership spill in Canberra. The Federal Liberal Party has a new leader. Tell us what happened.
Well, a bit's happened, Anthony. As expected, Angus Taylor has rolled Susan Lee. Angus Taylor is now the new leader of the Liberals with Jane Hume as his deputy.
Okay.
So that was pretty much as expected. It did seem to take a long time for this to come to a head this week. Nevertheless, we got there in the end on Friday, but then we've got another little twist in the tale. Susan Lee has immediately said that she will quit Parliament, which sets up a test for Angus Taylor's leadership almost immediately, because that seat will go to a by-election. Can the Liberals hold on to Lee's seat? That's a bit of a mystery. Imagine, Anthony, if you get this circumstance where Taylor comes in having won the leadership and then immediately he's one seat down. That would be the worst of all worlds for the new leader. A real blow to his honeymoon period, such as it is. I mean, Anthony, this is all just a bit messy to me. I saw Angus Taylor out on the hustings last year during the election when he was the shadow treasurer. I remember a debate down in Melbourne where he took on Jim Chalmers. It was towards the end of the campaign. Everyone was pretty tired, but Chalmers just wiped the floor with Taylor. Taylor really struggled to land any blows. And I wonder whether, for the Liberals, he's really the guy to lead them out of the wilderness, or this is just they needed a new voice, they needed some change. He's the next soldier up. He doesn't seem to have a great policy platform, does he? It's hard to identify how he's going to be all that different.
Yeah, no idea what he stands for or they stand for, James. The Liberal Party's a rabble, the coalition's a rabble. Very, very little discussion about policy. I mean, you do have to feel a bit for Susan Lee and all this. She's held that seat for 25 years. She took a really tough job trying to stitch the Liberal Party and the coalition back together after an embarrassing defeat at last year's election. She's lasted less than 12 months. Clearly, Liberal Party members are worried about their own jobs and worried about an election in the future, and that's fair enough, but it's hard to see the road back being an easy one.
Yeah, and we do need a strong opposition. Democracies work best when governments are being held to account by the opposition regularly, so we need the Liberals to get this right, but it seems like a bit of a long road back at the moment. Okay, Anthony, let's move to our first big topic of the week and strap on your boxing gloves because there's a new bank battle brewing. In the yellow corner is Australia's biggest bank, the undisputed big kahuna of the sector, Commonwealth Bank, which flexed its muscles this week by delivering a bumper $5.4 billion profit for the 6 months ended December, along with record loan growth and very strong growth in deposits. And then in the black and silver corner is the up-and-coming challenger Macquarie Group. Its banking division has had a stunning 5 years of growth, gaining more market share in home loans and deposits than any other bank in history has ever managed over a 5-year period. Now, on Tuesday, we got some more news from Macquarie. It revealed that its return on equity for its banking division is about 13%, which is up there with CBA, and it's actually better than ANZ, NAB and Westpac and all of our regional banks. Anthony, we've always talked in banking about the big four. I think it's really time to start talking about the big five, but I pose this question to you. Is it actually the big two, CBA and Macquarie?
This is corporate Australia's new ding-dong battle, James, isn't it? It's come from nowhere and it's now up there with Qantas versus Virgin or Woolworths versus Coles, BHP versus Rio. CBA and Macquarie, two of our top companies, both in financial services, both, reputable, profitable, well-performed for shareholders. But they've never really gone head-to-head. Macquarie was investment banking and stockbroking. And by the time it got into asset management, CBA kind of was retreating from there. Macquarie was much more globally focused. CBA was always in Australia. But now Macquarie's built this Australian retail bank right in CBA's patch. And we've just got this delicious battle brewing. Macquarie, James, like you said, it's growing like a weed, admittedly off a small base, but it's now too big to ignore. It's too big for us to ignore, too big for CBA to ignore, too big for the regulators to ignore. It grew its mortgages book 25% last year, right? CBA grew its 7%, and that was the best of the major banks. Macquarie grew its retail deposits 36% last year. CBA, once again, the best of the majors, 9.7%. So to be clear, CBA, Westpac, NAB and ANZ, they're still much bigger than Macquarie in retail banking. However, Macquarie's catching up faster than anyone expected, faster, like you said, than any bank's been able to do before. So it's alarming for each of the big four banks, but it's most alarming for the biggest and the strongest. And you'd have to say the biggest beneficiary of the big four system and the one with the most to lose, and that's CBA. Yeah. So it's kind of incumbent on CBA to stop Macquarie's rise. The other three banks, they're sort of in no position to do it or don't have the funding or the tech set up or the platform to go head-to-head with Macquarie at the moment. So we've seen CBA, lead the fight back. It's invested in tech. It's rethought how it writes mortgages. It's gone harder, in both the mortgage brokers distribution system and then writing more of its own loans. It's playing around with customer loyalty and pushed much harder into business banking, all this stuff to kind of to shore up its own position, but also take on Macquarie. But there was a time when CBA boss Matt Comyn was happy to sort of let competition play out and maybe not push so hard. But we saw in their results this week, CBA's amongst the big four, it's the one that's pushing loan growth the hardest, right? It's the one that's fighting the hardest. So I think it says to us that he thinks he's in this good position where he can push back. He is pushing back. But the week started, James. Macquarie had an operational briefing on Tuesday. What did you learn about why its bank is so disruptive and how is it hurting the smaller banks?
Well, Anthony, part of it is about what Macquarie doesn't do and the big banks have to do. The obvious thing there is branches. The big banks like CBA and ANZ, Westpac, NAB, even the regionals like Bendigo and Bank of Queensland, they have to be sort of all things to all people. They run branches, networks across the country in rural and regional areas where it's expensive to serve those customers. They've got sort of, whether it's specific obligations about providing universal banking services or implied ones, basically politicians want them to keep branches open, etc. So that's one point about it. But I think what we're seeing here is the battle shifting. For the last 10 years, probably longer, it's been all about home loans. Who's going to take the biggest share of the home loan market? But the problem with home loans is they're all being commoditized by the rise of mortgage brokers. They're not very profitable anymore. So the battle shifted to deposits, and that is where Macquarie is absolutely setting out this big challenge. Most of us, who bank with a mainstream bank, we chuck money in our normal transaction account. We don't get much interest on it, ever. And we're sort of okay with that. It's sort of the price of admission. Macquarie's turned that on its head. You can get an interest rate of 2% in Macquarie's transaction account. And then in savings accounts, lots of us have savings accounts that might pay, I don't know, I'm picking a number here, above 4%. But there's a lot of hoops to go through. You might have to increase your balance every month or perform a certain number of transactions in your account or whatever it is. Macquarie's offering is an interest rate above 4%, and they like to say no hoops, no catches. And so this is a big challenge because it says what Macquarie calls a liability-led strategy or a deposit-led strategy. It throws out the gauntlet to smaller banks particularly. Why? The cheapest form of funding to write a loan is deposits. But if you're a smaller bank and suddenly you're finding your deposits are migrating to Macquarie and you're finding it harder to get deposits, that means you've got less capital to lend out. Now, there's two ways you can approach that. You can reduce the amount you're lending, not great for growth, or you can go and find funding at a more expensive rate than deposits. And so that's not great for your profitability. So there's this squeeze on the rest of the market created by Macquarie wading into the deposit market in such an aggressive way. So Macquarie's trying to upend that model. Now, Anthony, Commonwealth Bank Chief Matt Comyn, he didn't actually mention Macquarie by name on Wednesday. He's always very careful about that. But he argued that an unnamed rival has advantages because it doesn't have the same obligations as mainstream banks around capital. It doesn't have the same obligations such as running branches or handling cash, which is very expensive, or sort of playing a role in the community. Does Comyn have a point here, or is he just hoping that that competitive threat from Macquarie might be blunted somehow?
Yeah, Matt Comyn's got this habit, doesn't he, where he doesn't mention the rival bank by name, but it's never too hard to follow what he's talking about. And Macquarie, speaking one day after their operational briefing was very much front of mind for him and I guess for us. Like you said, James, Macquarie makes no apologies for its very deliberate strategy of running a digital bank, right? A very different proposition to CBA. Not just a digital bank, but a branchless bank, right? And not having branches, like you said, it's an absolute game changer. It's a game changer politically. It's a game changer for customers. It's a game changer for the cost base too. It also doesn't have this incumbency that the Big Four carry around. Now, the incumbency for the Big Four is a real competitive advantage in one sense. Like it establishes their presence in the market. But with it comes all these expectations of what it does and doesn't have to do. And the politicians are so quick to jump on their back and jealously guard, particularly regional branches, customer service, that sort of stuff. And Macquarie doesn't really have to worry about it. Macquarie doesn't have to worry about it because it's got 4 other banks that are copping it in the neck. So the politicians feel like they've got enough targets, and then Macquarie sort of gets away scot-free. Where we need to think more though, James, and I think analysts are already going that way, I know you've been speaking to Macquarie about it as well, is on the capital position. Like, what do you think? I mean, do you think that Macquarie has an unfair advantage on the capital side of the equation, not just all this sort of expectation stuff?
This is really complex, Anthony, and I've got to say, the analysts are struggling to get to the bottom of this, and even inside Macquarie, I think they would acknowledge that it's a complex message to get across. The view of the main inside the Big Four is that Macquarie does have a capital advantage because of the way the group is structured and the bank is structured. Macquarie says that's rubbish. The capital advantage is not anywhere near as portrayed. While Macquarie isn't what's called a DSIB, that's a domestically, systemically important bank, and that's what the Big Four are, it says that it has other capital imposts on it that effectively wash out any capital advantage that the other banks think it might have. I think this capital debate's going to roll on, but I think it comes back to this broader idea that you went to, Anthony. Macquarie's got this challenger model, and in some ways, it's the model that all the mainstream banks would love to have. You know, no branches, no cash, just a really competitive offer. I think the other point, Anthony, this doesn't get a lot of mention. How good for consumers to have these banks absolutely tearing each other down to get home loan business and deposit business. Maybe politicians and regulators are going to stand back and go, hey, this is exactly what we want, a fiercely competitive banking sector. Bring it on.
Where do you think the battle goes, James? And if Macquarie's so disruptive, why are investors buying bank stocks again like they can't get enough of them?
Oh, that's a great question, Anthony. The banks have absolutely flown this week. The whole banking index, I think, for the week's going to end up about 6%, thanks to the big moves in CBA and ANZ. So, you know, if Macquarie's that disruptive, why are CBA and ANZ shares going so hard? I think there's a bigger story going on there. Investors are worried about everything to do with AI. They're looking for a defensive place to park their money. Hey, what's better than the banks? So I think there's that story playing out. But where does the battle go? I don't think there's going to be a major change. Macquarie is hungry to get more growth in deposits and home loans, and it's going to keep pushing. CBA will keep using its scale to defend its position and try and grow. Everyone caught in the middle of this battle is going to be struggling, or going to have to find ways to respond. The regional banks and the other 3 majors, NAB, ANZ and Westpac, they're going to have to figure out how do they respond to this. They don't necessarily have the scale that CBA does, and they aren't, you know, the most nimble organisations in the world. They're sort of big lumbering bureaucracies that do have the branch networks, the cash obligations, all that sort of stuff. So, in a way, the 2 entities duking this out most fiercely, CBA and Macquarie, they're going to be okay. They're going to keep whacking their way at each other and they'll all be all right. It's everyone else, everyone in the middle who I think we need to really watch closely.
Yeah, James, I think CBA realises ANZ's Nuno, he's not going to stop Macquarie. NAB's Andrew Irvine has a fantastic business bank, but he's not going to stop Macquarie in retail banking.
Yeah.
Westpac's Anthony Miller, I mean, he's probably got the sleeping giant in terms of the big retail bank, but he's more a business banker. I mean, he's got a complicated tech project to oversee first. He's probably not going to stop Macquarie. So who is it, right? And that's where it comes back to CBA in common. You know, perhaps this could be his 3rd act at CBA. 3rd and final, maybe, who knows? But it would be a good legacy to leave shareholders if they could really, you know, put a dent in Macquarie's growth and shore up their own position in what is shaping up to be quite a different market.
The best thing for all of us, Anthony, banking's not going to be boring for a long time to come. It's going to be a really interesting fight to watch.
Okay, James, let's move to our second topic. And if reporting season wasn't already dramatic enough, this week we saw not 1, not 2, but 3 CEOs of blue chip companies depart their posts in less than glorious circumstances. James, rattle them off for us quickly and give us the reasons for their departure.
Well, on Tuesday afternoon, Anthony, just before the market closed, as it turns out, CSL announced that Paul McKenzie, their CEO of less than 3 years, is retiring. He retired so quickly that he was out the door that afternoon, which was remarkable.
It's quick.
Also on Tuesday afternoon, our old friend, Tony Boyd, former Chook, he broke some great news with our colleague Joyce Malarkis that at the ASX, Helen Lofthouse, the CEO, was on the way out, and they confirmed that a little bit later on Tuesday evening. And then on Thursday, a Lend-Lease, which is a storied company in Australian business, it announced that Tony Lombardo will retire and exit in August. So pretty incredible, Anthony. 3 CEOs in 3 days, 3 big names. And yeah, they've all been under pressure for some time. All 3 of those companies have had performance issues and particularly pressure from their investors that's built and built and built as their share prices have moved lower. So they weren't a surprise individually, but it was striking to sort of lose these 3 CEOs in 3 days, adding to the drama of reporting season. But Anthony, I think CSL really stands out here. It's one of the bluest blue chips Australia's ever had, yet it has been hammered in the last 12 to 18 months. Is there a path back to glory for this company and its shareholders?
The red flag stretched back 5 years, James. It did really well in the pandemic. Coming out of the pandemic, it bought this big thing, paid $16 billion for a Swiss business called Vifor, which develops drugs for iron deficiency and kidney-related therapies. Paid too much. That acquisition was slow to fire.
Yeah.
Took a lot of management's time. There were already concerns about CSL's capital allocation and its spending on R&D, whether it was still getting bang for its buck in developing new therapies. And basically, it all just sort of came to a head in the past 12 to 18 months, James. Meanwhile, CSL was also keeping investors happy by telling them margins in its core business were going to increase. That didn't really happen. So there was a lot of belief and a lot of trust in this company that sort of dissipated in the past 6 or 12 months, James. So if you look at just the past 6 months, we've had earnings downgrades, share price tank, plans to spin off a division, the CFO gone, a strike remuneration report, the spin off on hold, CEO now gone, share price keeps tanking, and it's been tanking all week, James. So we've now got an interim CEO, board chaired by the former CEO and Australian business royalty, Brian McNamee, and very much a cleanup in aisle 4. Like you wrote this week, James, it's now about investor trust.
Yeah.
Trust in the turnaround, trust in the pace of it, trust that the core business is rock solid, trust in CSL's ability to keep innovating, to keep developing new products. And unfortunately for them, like I said, that's trust that's gone. So investors have kind of taken away the pen license in a way from CSL. They've put that capital allocation under scrutiny, which impacts CSL's ability to reinvest in itself and gets you questioning whether the whole model unwinds, So it needs to just go through the hard yards, win back the trust, start being able to invest more in itself again. Meanwhile, there's a lot falling on the shoulders of the new CFO, James, Ken Lim.
Yeah.
And there has been since he came in a couple of months ago. It's going to take a bit of time. But James, CSL and all the companies that are changing the CEOs, they've been underperforming in one way or another. I mean, shareholders have grown impatient. But do you think investors are less impatient than they used to be, say, 5 years ago?
I think so. I think they're generally less impatient because they feel they have to be. As you said earlier, that there's fewer active managers in the market, and those active managers that are left are under severe pressure from passive strategies. So those active managers want to perform. How do they perform? Well, they go in and knock on the doors of the chairman of companies and they say, hey, we need change here. This isn't good enough. We need a new CEO. We need new strategy. We need to sell that business or do something here. So I think we're seeing shareholders become a lot more active and yes, a lot more impatient. We're also seeing shareholders figuring out the beat of the market. We talked before about AMP. It's just a fact of life now that you can get these massive share price swings. So you don't want to be caught on the wrong side of that. So yes, when shareholders see something that they don't like, they are going to get on the front foot and say, hang on, we need to stop this before it becomes a bigger problem. And at CSL, at Lend-Lease and at ASX, they just haven't been able to do that. I mean, what I'm struck by, Anthony, is just how quickly investor faith can erode and these companies can go from being well loved to sort of being, to being completely in the naughty corner. I mean, CSL shares now are down 45% in 6 months. This is a company that was worth, $180 billion not that long ago? Its value is just disintegrating before our eyes. That's the bit that I can't quite get my head around. You're a markets guy. I mean, is this just the way things are now, that things can fall apart and, by the same token, rise very quickly in such short amounts of time?
James, CSL was worth more than CBA on a market cap basis 5 years ago.
Yeah, there you go.
Now CBA is hovering around 300 billion and CSL's at 75 billion, a quarter of CBA. Isn't it? It's amazing. Yeah, you can lose your glow. You can lose that investor trust. It does take time for a blue chip like CSL, but can happen. James, get your crystal ball out. So We've had 3 CEOs go this week. We had 2 other ASX 200 CEOs go in the past couple of weeks. Clearly, it's killing season. Can you give us your top CEOs, ones still in their jobs, who are under the pump?
Yes, I'm going to start in the software business, which is under severe pressure from AI. Sukhinder Singh Cassidy at the SME accounting software business Xero. Now, she started in the role about 3 years ago, and frankly, Anthony, she's become a bit of a hero for a lot of investors. This share price ran very hard because Singh Cassidy was able to balance growth and profitability, which are 2 things that tech companies don't always get, the balancing act right. But she seemed to be able to do it. But all of a sudden, again, in 6 months, 60% of the value of this company has just disintegrated. Why? That they did a big deal in the US that the investors are unsure of. And then you've got this tide of AI skepticism that is just smashing every software business in the world. So Singh Cassidy's under the pump because she's got to do 2 things at once. She's got to convince everyone that this acquisition was okay and then push back the tide of AI skepticism too, which is going to be very difficult. Couple of others from me. Amanda Bardwell at Woolworths. Yep. Now, Woolworths has been a bit down in the dumps for some time. I think Amanda Bardwell's under the pump because Woolworths has recovered a bit. The stock's actually up 25% in the last 3 months because people are betting that Woolworths will turn it around. So Amanda Bardwell will report Woolworths numbers in a couple of weeks. Those numbers have got to be good. They've got to show investors that their faith was well placed, or that business will be under the pump. And another one from the consumer sector, Sam Fisher of Treasury Wine Estates. He's very new. He's only been in the job since October 27, but the pressure here is everywhere. Now, Treasury Wine Estates, their big brand is Penfolds, and he's fighting lots of different battles. He's got a big problem with weakening sales in China. His US business is an absolute mess, and he's got a European billionaire called Olivier Godot on the registry now with a 5% stake that was revealed in December. So that is a bad combination. Pressure from a big investor and a couple of bad things going on in the market. That is enough to drive you to drink, so to speak. Anthony, who are your CEOs under the pump?
ANZ's Nuno, the person that doesn't need 2 names like Jesus or Beyonce or Chanticleer. He lives under the pump. He's swung the axe so hard at ANZ. He's put some ambitious targets out there, really shaken up the joint. Now he's got to stick the landing, always the hardest part. Craig Scroggy at NextDC, a lot going on in data centers, huge build out, absolute generational opportunity. NextDC, the number 3 player in Australia, wants to be a big part of it. Right now, all the negotiations are going on. There's a scramble for customers, for capital, for power. It's all going down at the moment. Scroggy also needs to stick that landing. And last one, James, I'm going to go with Shamara Wickramanyaka at Macquarie. Okay. And CSL's the warning here. You can fall from the sky. It doesn't happen overnight, but it does catch up to you, right? And there's some chinks at Macquarie. We spent half this episode talking about the rise of their Australian banking business, which is great. But you look more broadly, there's been a succession of regulatory issues. It's been overtaken in its bread and butter infrastructure investment business. It's got assets on the balance sheet it's not been able to sell for a few years now. It's got a volatile commodities business that's still hard for investors to track. It copped a strike to its remuneration report last year. It's lost some big name talent like Nick O'Kane, the key commodities trader. Now, just because investors and perhaps even us in the media and Australia as a whole want Macquarie to do well, doesn't mean it has a God-born right to. So I think there's a bit of pressure on Shamara and Macquarie as well.
Yeah, great nominations, Anthony. It's going to be an exciting year, and there's still a couple of weeks of earnings season to run, and the numbers that are produced will help determine who stays under the pump and who can get out from under it. So watch out. We'll bring you all that over the next couple of weeks. We're also going to go to a break now, and we'll be back with a very interesting question about how we can tackle inflation without hiking interest rates. Back in a sec. Well, welcome back. If you want to know more about what we're talking about today and a whole lot more, AFR subscribers can sign up to the Chanticleer newsletter at join.afr.com/Chanticleer. Every Saturday morning, the newsletter pulls together the best Chanticleer columns from the week and delivers them straight to your inbox. All right, Anthony, another big week. Results roll on. Monday, we've got Bendigo Bank and JB Hi-Fi and BlueScope. Tuesday, another big kahuna in BHP. Wednesday, we've got Suncorp and a trading update from NAB, Telstra and Wesfarmers on Thursday. Wow, we're going to have another busy week.
Heaps of results.
And then there's some really interesting economic data. Obviously, we're all talking about where rates are going, and we'll get some good clues this week. On Tuesday, we've got the RBA minutes from the last board meeting. On Wednesday, we've got the wage price index. Remember that the RBA told us that real wages, that's wages excluding inflation, are going to be going backwards over the next few years. And on Thursday, we get the unemployment rate. So, Anthony, this will all help build up the picture as to how hot the Australian economy is running.
Yeah, really interesting combination of data, this, James. The unemployment rate in particular was 4.1% last month. Economists think it's going to be 4.2%. I mean, that's not a big change, but it's still a rise at a time when RBA is increasing interest rates and just trying to balance, its two big goals, inflation and full employment, which is looking incredibly tricky.
Yeah. Michelle Bullock had a pretty testy session in Senate estimates this week, so it'll be interesting to see what the data tells us about where rates are going. All right, we love questions here on the Chanticleer podcast. This week, our questions from Anthony in Brisbane. If you've got a question you want to send in, you can email us at chanticleer@afr.com. We've got a link in the show notes that you can use. You can also send us a question in audio form. Just record a voice memo on your phone and include your name and where you're from and email it to us. And of course, there's a widget on the bottom of most Chanticleer articles at afr.com that allows you to ask a question too. All right, this week's question, as I said, is from Anthony in Brisbane. We're going to ask our producer, Mandy, to do the honours.
All right, Anthony says, hi guys, love the podcast. I live in an affluent inner city suburb in Brisbane. Most of the older population with millions in their super, property, etc. would barely have even noticed the latest rate rise. They would have shrugged and ordered another latte, an almond croissant, bought a Tesla and booked another cruise. Their consumption of luxury cars, cruises, restaurants and more stuff will just continue as they try and spend their millions before they leave this mortal coil. The rich are spending more while the poorer are being penalised with rate rises and income tax. Can you both come up with suggestions to reduce inflation other than rate rises? If you were PM or Treasurer for a day or a term, what would you do? Higher GST, more indirect tax, more luxury taxes, specific ideas, or the need for bipartisan political ideas?
It's a great question, Anthony, and it's never easy to put the hat of the PM or Treasurer on because they've got a lot of political things to think about as well as sort of economic ones. Where would you start to try and tackle this?
It'd be great to be PM for a day, wouldn't it? Just one day. You didn't have to worry about re-election. You come in and just shake it up. I think the penny's really dropping on this one, James. We've been talking about it for a while, and I think the upcoming budget, it's a big one on this front. I agree with Anthony. Yeah, GST up, tax consumption more, income tax down, incentive for people to work more, earn more. And then the focus has got to be on wealth taxes. And that's kind of where it's going in Canberra at the moment with the talk of the capital gains tax concessions. I mean, if you're serious about the property market, you'd also be having a discussion about negative gearing. And if you're Prime Minister for a day, I think you could afford to do that. It wouldn't blow up in your face. I mean, they're the obvious places to me to start. What do you think, James?
Yeah, I mean, there's some innovative ideas around the world. Singapore, in addition to interest rates, uses a mechanism by which sort of takes spending out of the economy by directing it to savings. The rate at which you save into their version of super increases. So that's an innovative idea as well. But the problem with all these ideas, Anthony, is that you're going to run into two issues. The first is, who really wants to see an increase to tax of any type? I mean, just imagine how difficult that would be to get past the Senate. So you've got that problem of practicality.
Mm-hmm.
And then you've got the issue, I think, of, I don't know, maybe you call it individuality. Everybody's different. And so, some retirees are sitting there, Anthony, from Brisbane, we're booking cruises, sipping lattes and eating almond croissants, but not all. Every one of these measures, you would probably have to have some sort of carve-out or exception or targeting, which then makes the impact of that individual instrument just a little bit weaker. And so you might need to tweak $55 in the economy to take out inflation versus that one very large lever called interest rates. And interest rates are, as we say all the time, a very, very blunt instrument, but that can also be a good thing. The idea here is that it sends a signal about the price of money, not just for homeowners, not just for renters, not just for retirees, for everybody. It says, the increase in interest rate says to mortgage holders, okay, we need to pull our horns in. It says to retirees, okay, there's a better rate for our savings. We should take advantage of that. Now, does it work like that all the time? No, it's definitely imperfect. It's definitely blunt. It definitely hurts lower income people, hits them harder, particularly at the moment. But that bluntness is part of the attractiveness of interest rates, whereas the practicalities around a lot of these other measures that we've suggested are just so difficult that they just would never happen. So I think, Anthony, I get what you're saying, but I think we're stuck with interest rate rises. The other great thing, even if we were Prime Minister for a day, Anthony, just a day, the other great thing about interest raises is you can blame it on someone else. It's never the politician's fault. It's always the Reserve Bank's fault, that independent arbiter over there. Point the finger at them, please, not us. So, yes, I do get where you're coming from, Anthony, but tax reform in this country is cooked, so I think you can put those ideas to one side. The big blunt hammer still does the job.
We could debate this for a whole episode, James, but I do think we can handle complexity. We brought in GST and we carved out fresh fruit and vegetables. That's completely uncontroversial today, and I think it works. In regards to superannuation, I'm just not sure you can take more than 12% of people's wages to invest in the future. I mean, then you really will be putting more pressure on the people that are probably struggling to pay the bills as it is already, let alone those with mortgages and rates are going up and they're struggling. So I see some flaws with the super system and how, Singapore's policy could fit into Australia when we already have such a strong amount of wages going into retirement savings. I just wish we were brave enough to tackle tax, James. I mean, I get what you're talking about. Politically, incredibly hard. Oppositions lose elections proposing tax changes all the time. But it is going to get to a point where I think society wakes up and realises there's going to need to be some short-term pain out there to reset for future generations.
Yeah, well said, Anthony, well said. All right, Anthony, it's been a huge week of reporting. Some big companies, big heads rolling. What are we going to get next week?
Yeah, some more 30% price swings maybe, James.
We'll bring them all to you next week. Thanks for listening this week. We look forward to joining you then. If you like the podcast, send it to a friend as it helps others find us. And don't forget to follow wherever you get your podcasts so you'll never miss an episode. At The Financial Review, we investigate the big stories about markets, business and power. For more, go to afr.com and you can subscribe to The Financial Review, the daily habit of successful people. Chanticleer was hosted by me, James Thomson, and Anthony Macdonald. It was produced by Mandy Coolin and our theme is by Alex Gow. Head of audio is Alex Gow and head of premium content is Fiona Buffini.
The Australian Financial Review.